The following was taken from the records of Cadbury dealers. Statement of financial position as of 28 February 2014, 2014 and 2013. Had land and buildings, vehicles, equipment, inventory, debtors. Now, watch out for this one. Rent income accrued. What does that pertain to? Income or expenses? It pertains to income. But rental income, we said we're going to treat as a separately disclosable item. So watch out when you're going to show rent paid, because you need these amounts in order to calculate rent paid. Also, here we have prepaid expenses. What does that pertain to? Cash paid to customers, to suppliers and employees, because it's all about expenses. So when we do working capital changes, we must remember that to take this into account as well. Bank, then we had capital, an interest-bearing loan of 10%. Creditors, short-term portion of the long-term loan. So remember, the total loan balance will be those two balances together. So if you're going to work out a D account, you're going to add those two balances together. We have accrued expenses. What does that pertain to? Expenses. So when we work out working capital changes for expenses, we have to take this into consideration. Accrued interest expense. Interest paid is shown as a separately disclosable item. So we must take the accrued expense into account when we calculate actual interest paid. Then our statement of profit and loss, sales, cost of sales. We have other income, rental income, profit on the sale of the vehicle, profit on sale of the land, depreciation, loss on the sale of equipment, and sundry operating expenses. We also have finance cost and then our profit for the year. Obviously, this is a before tax profit, unless I made a mistake in the disclosure. You determine the following. The owner of Cadbury dealers obtained, just one moment. Cadbury dealers, nowhere Pty Limited, nowhere limited. That is why the income statement stops at profit for the year. Why? Because the owner in his own capacity is responsible for the tax. Equipment with a cost price and accumulated depreciation was sold. Then they give us vehicles. Vacant land was sold. So it's a lot of PPE transactions that took place. Therefore, we're going to have to draw the T accounts of all the PPE accounts. Assume that finance costs for the year have been calculated correctly. The first question is calculate the amount paid to suppliers and employees. Not do the cash flow statement. B, ask you the investing activities, PPE accounts, and financing activities sections of the statement of cash flow. And C, ask you the reconciliation of the profit for the year and the cash generated from operating activities. Good. So let's start with amount paid to suppliers and employees. Now, we know that we start that calculation with profit before tax. And we have the profit before tax, which was 48,000. And then we're going to adjust it for non-cash flow items, separately disclosable items, and working capital changes that has something to do with expenses. So let's start redoing the PPE accounts, because there we're going to get a lot of non-cash flow items. And in the B part, we have to show the investing activities. So we're going to calculate a lot of those figures as well. So draw yourself T accounts of each and every asset that we have. So you're going to have a T account for land and buildings at cost, opening balance 375, closing balance 300,000. Opening balance 375, closing balance 300. Vehicles at cost, opening balance 22,500, closing balance 120,000. Opening balance, closing balance. We have accumulated depreciation on vehicles, opening balance 2250, closing balance 30,000. Opening balance, closing balance. Equipment at cost, opening balance 82,500, closing balance 82,500. opening balance, closing balance. And then accumulated depreciation on equipment, opening balance 15,000 and closing balance 30,000. 15,000, 30,000. Now we can go and have a look what happened to our PPE items during the year. Before we drop down too far, when I look, I only have capital here. There's no revaluation surpluses. So therefore we can assume that no revaluation of land took place during the year. Let's ignore number 1 first. Number 2, equipment with a cost price of 15,000 and accumulated depreciation of 3,000 was sold during the year. So let's open up an asset disposal account for equipment. Here it is, asset disposal. We take out the 15,000 cost price and we take out the accumulated depreciation of 3,000 as at the date of sale. When we go back to our income statement, we see that we made a loss on the sale of equipment. There it is, a loss on the sale of equipment of 750 Rand. So now we can account for the loss in the asset disposal account. There it is, the loss, and by balancing this account off, we can now actually calculate what the proceeds was with the sale of this equipment. New equipment was purchased to replace the equipment sold. That's all that we have about equipment. So going back to the cost account, we are going to balance that off, and there they told us it was for replacement purposes. So there's the 15,000. Guys, we have to do in the second part of the question the cash flow of investing activities. So we might as well write it down and start completing it as we go along. Equipment purchased for replacement purposes, 15,000. Proceeds on equipment sold. We've also worked that one out. Proceeds on equipment sold. There, 11,250 Rand. 11,250 Rand. Okay, did they give us depreciation in this question? They haven't. Oh, they have, but only in total. Depreciation, 52,000 Rand. So let's just mark that one, because maybe somewhere we will have to work out what the balancing figure was. Good. Going back to the accumulated depreciation of equipment account, we can now balance that one off, and the balancing figure in this account is then going to be our depreciation charge for the year, 18,000. So the balancing figure in the cost account is our new replacement value. Our balancing figure in the accumulated depreciation account, our depreciation. Great. Now let's do the next one. Vehicles. A new vehicle for use in the business was purchased during the year at a cost of 127,400. So in our vehicles at cost, on the debit side, new vehicle 127,400. In our cash flow from investing activities, vehicles purchased, replacement, 127,400. So outflow of cash, therefore a minus. Total depreciation for the year on all the vehicles amounted to 34,000 Rand. So on the accumulated depreciation account, here on the vehicles, 34,000 Rand depreciation. One of the old vehicles with a carrying amount of 23,650 Rand was sold during the year. Now, important carrying amount, they do not give you the split of what was the difference between the cost price and the accumulated depreciation. But when we go to our T accounts, we see that there's a balancing figure needed on the credit side of the cost account. And there's a balancing figure needed on the debit side of the accumulated depreciation. Now, if we balance these accounts off and we see 29,900 less 6,250, that then brings us back to the I don't know why I added it. That brings us back to the carry value. Oh, there's the carry value. 29,900 less 6,250 gives us the carry value of 23,650. 23,650. So then I transfer the 29,900 to the asset disposal account, and I transfer the 6,250 to the asset disposal account. They told us in the question that we have made a profit on the sale of the vehicle. There it is, profit on the sale of the vehicle of R1,000. Now, in our asset disposal account, the carry value of the asset is now 23,650. We've made a profit of R1,000, so we received then 23,650 plus 1,000, 24,650. Proceeds on the sale of vehicles, and that you can go and park in your cash flow from investing activities. Proceeds, vehicles sold, 24,650. Now guys, coming back to this one here, they made it quite easy for you to work back to the 23,650 because it was a balancing figure of 29,900 and a balancing figure of 6,250. If it was me, I would have made it a little bit more complicated, and probably I wouldn't have given you the full depreciation, or I wouldn't have given you the disposal, this accumulated depreciation on the disposal in total. I could have left out another figure. I could have told you that the proceeds was 24,650 and the carry value was 23,650. And then I could have had that you can work out what was the cost price, 2,900, and maybe there was something else in one or other account that I left out. So when you do these calculations, when you do these exercises, just don't take everything for granted. After you've done the exercise, go back to the exercise and see how you could have made it a little bit more complicated. What else, what other figure could have been left out and you would still have been able to calculate whatever was required from you? Good, let's have a look at the land and buildings. We've done vehicles. They tell us about land. Vacant land was sold during the year for cash. Now, we have already established that there was no revaluation surplus. There was a profit on the sale of land of 15,000 Rand. So going back to the land account, which we have an opening balance and a closing balance, there's no accumulated depreciation on land. It means that the difference here, the 75,000 Rand, was the cost price of land sold. So we're going to do that, the asset disposal, land and buildings, 75,000. We made a profit on the disposal of 15,000. They gave you that. So therefore the proceeds on the sale of this land was 90,000, and you can go and park it here. Proceeds on the land sold, 90,000. And just by reconstructing all your PPE accounts, you have actually completed your cash flow from investing activities. There was no other investments, so therefore you're done with this one. When you add all your depreciation charges, here we had 34,000. On equipment, we had 18,000, and if we add those two together, it gives us total depreciation for the year of 52,000. And in my income statement, there was total depreciation for the year of 52,000. So straightforward. Okay, now, well, we haven't answered the A part of the question at all as yet. So let's go and calculate the amount paid to suppliers and employees. We said we're going to start that calculation with our profit figure, 48,000. The first thing that we have to adjust our profit figure for is non-cash flow items. Now we have actually established that the profit on the sale of the vehicle is non-cash flow. So it was an income. Therefore, if I want to take it out, I have to deduct it from profit before tax. Profit on the sale of the land. That is non-cash flow. So it increased our profit. So if we want to eliminate that, we're going to subtract it from our 48,000. other expenses, loss on the sale of equipment, 750 Rand. Well, there we're going to add it to eliminate that to profit before tax. And depreciation is also a non-cash flow item, 52,000. We're going to add it to the profit in order to derive at to eliminate that out of profit before tax. So we start with the 48,000. We're going to have the depreciation of 52,000, loss on the sale, profit on the sale of vehicle, profit on the sale of land. Now we have to eliminate separately disclosable items. We're treating rent income as a separately disclosable item. So therefore we're going to take it out. Rent income, 14,400. And even if we didn't take it out, it is all about income. And that rental income, I have a choice. I can either include it with my cash received from customers, or I can show that as a separately disclosable item. So either way, I have to take it out of my expenses, because remember, cash paid to employees and suppliers is all about expenses converted into cash, and rent income is, as sure as I'm sitting here, not an expense, it is an income. So we eliminate that one. Finance costs. There's finance costs included in my profit. Now remember, what do I do here? I adjust my profit figure. I adjust my profit figure. So what was the finance cost included in my profit figure? 40,650. So that I'm going to take out of there. Another item I have to take out, because I'm only working here with expenses, is my revenue figure, my sales figure of 600,000. So I'm also going to take that one out of my profit before tax. So that will leave us then with total expenses in the income statement. All other expenses in the income statement, which is not a non-cash flow item or a separately disclosable item. Now we have to adjust it for accruals. So going to my statement of financial position, the first thing that has something to do with expenses is going to be my inventory. So there was an increase in inventory, and an increase in inventory represents an outflow of cash. Prepaid expenses, guys, it's all about expenses. So we have to take that one into account as well. And there was an increase in prepaid expenses. So that increase also represents a cash outflow. I've paid this money. I didn't have to pay the money, but I did pay this money. So it was an outflow of cash that happened. Accrued expenses, yeah. It's got something to do with expenses, so we have to take that into account. There was a decrease in accrued expenses during the year, so that means that I have paid my accrued expenses. So it's an outflow of cash. And then creditors. There's our creditors. It was also a decrease in creditors, which is also a cash outflow because I've repaid my creditors less creditor finance, 5,750. So net cash paid to suppliers and employees, 521,500. So what haven't we answered as yet? That was cash paid to customers and employees. Number B, we've done the investing activities, but they also require from us the financing activities section of the statement of cash flow. So let's go to the financing section of our income statement. And we see here we had capital. And there was an increase in capital. But guys, what will actually happen if capital increase? That 48,000, isn't that supposed to be added to the 461,400 to derive at 419,250? Well, clearly there was a reduction in capital and not an increase in capital. So we have identified that Cadbury is not a company but a one-man band. So that means that the owner has drawn money out of this entity during the course of the year. Last year's capital balance, 461,400, plus our net profit for the year, 48,000, less our closing balance in our capital account. That means that there was drawings during the year of 9150. Cash outflow, therefore a minus sign in front of that. Let me just see this one. So there you can see clearly minus 90,000. Our long-term loan, let's go and have a look at our long-term loan. Our opening balance was 129,850 plus 65,000. And our closing balance was 318,150 plus the short-term portion of 150,000. So opening balance, the two of them together, closing balance, the two of them together. In the question they've told us that the owner of Cadbury obtained an additional loan from Beacon on 1 September. The total loan from Beacon is repayable in installments of 150,000 Rand each on 28 February each year. And we are busy with the year ended 28 February. So that 150,000 and that installment there, nowhere is stated that it includes capital and interest. So we assume that it is only the capital repayment of 150,000. So bank, 150,000, and that also has to be shown in our cash flow from financing activities, repayment of the Beacon loan, 150,000. Now, when we balance off this account, we see that on the credit side, we need a balancing figure. And the only thing that that can represent is that we have received an additional loan from Beacon Bank. So that 423,300 there, oops, that is then the additional loan that we've received, and that's a cash inflow, 423,300. The C part of the question is really half and half a repetition of the A part of the question. Prepare the reconciliation of the profit for the year and cash flow generated from operating activities. Why do I say that that is sort of a repetition of the A part? Guys, because the calculations looks very similar. The only difference is in my reconciliation, I do not take out any revenue. And in my reconciliations, I have to add the movement in my debtors accounts for the year. And I think in this one, there was rental income owed. So I'll have to take that into account as well. Rent income accrued. That was also part of our income, so that needs to be taken into account as well. So if we go to our calculation, we're still going to start at profit before tax again. Profit before tax, 48,000, exactly the same as there. We're also going to adjust it for non-cash flow items. Adjusted for non-cash flow items, profit on the sale of the vehicle, profit on the sale of the land, depreciation, and loss on the sale of equipment. All four of those items at exactly the same prices. Separately disclosable items. Now we have to leave revenue, but rental income and financing cost needs to be shown. So rental income and interest expense. Now the reason why they haven't included rental income here is because they've shown it as a separately disclosable item, and then it will not be included in the cash generated from operating expenses. So you have a choice. If you did include it in your revenue figures, in your cash received from customer figures, it would have appeared here. If you didn't, then because why? It will then have been included in this line item, cash generated from operating activities. If you treat it as a separately disclosable item, we're not going to show it here because it has its own line item underneath cash generated from operating activities. We will do one or two exercises like that, and you will understand clearly what I'm talking about. Then changing and in working capital. Now all of these will be there. Inventory, prepaid expenses, accrued expenses, and creditors, and then you're going to add to that debtors, increase in debtors, 7,500 rand. Increase in rent income accrued, 750 rand. So again here, increase in the debtors now needs to be shown, as well as rent income accrued. That increase of 750 rand, that needs to be shown here as well. And then you're going to add it all up, and that then will give you all your changes in working capital items. If you're going to add all this stuff together, it will be cash generated from operating activities, 84,650. Now, they don't ask it in this question, but let's assume that we're going to carry on now with our cash flow statement. What are you going to show as financing cost? In other words, interest paid on the statement, on the face of the statement of cash flow. Accrued interest expense. So what was my total expense for the year? My total financing cost expense for the year was, where did I tell it in my income statement? Yeah, finance costs, 40,650 rand. That was our expense for the year. But at the end of the year, I still owe 19,350 rand. So what am I going to show then as interest paid? Guys, the difference. So it's 19,350 deducted from our 40,650. So actual interest paid for the year would have been 21,300. So what I want to tell you is watch out for your separately disclosable items, because when I disclose that item, I disclose either received or paid. And if there are any accrued expenses or if there are any accrued income still on the statement of financial position, I have to take it into account when I'm going to work out what was the actual amounts received and the actual amounts paid. So put that in the back of your mind and remember that.